The best trades occur after the masses have been stopped out. And markets tend to move. And that's because the big fellas up there, they can't press the wee button and get in because there's just not enough liquidity there for them to get in size. So they have to, in fact, engineer 100,000 guys like you, sir. Pull you one way, your stop loss gets hit. That, in fact, sets off a sea of liquidity for them to get in. So even if you don't have the strength, or what I refer to jokingly as the testicular fortitude to buy at the level, if you can get in and you can see, using your cup here, you can see that lots and lots of people have been stopped out before you get in, then you're probably on the right side of the trade. The good trade's always the hard trade, always, but emotionally difficult. When it's time to buy, you won't want to.
Does that feeling sound familiar? The moment you're stopped out, price finally moves in your original direction. That's not bad luck. It's how the market works. What you just heard from trading legend David Paul is the real operating manual of the market. It's a feature, not a flaw. Welcome back to Com Lucro. In today's lesson from our Smart Money Concepts course, we're exploring one of the most important skills that separates professionals from amateurs. Understanding liquidity, the true language of the market. We'll break down how institutions manipulate price, how they engineer liquidity traps, and how you can recognize those patterns before they happen. By the end of this chapter, you'll see exactly how liquidity drives every move in the market, and how to trade alongside the professionals, not against them. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before diving into the liquidity patterns and scenarios that frequently form in the market, let's begin with a basic introduction to smart money and the fundamentals of smart money liquidity, and see what the exact definitions of these terms are. Imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trend. To thrive and succeed as a profitable trader, identifying liquidity on the chart is essential. These areas, where significant volumes of orders are present, provide valuable insights into market dynamics and help prevent substantial losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This causes the price to drop and fill the most recent fair value gaps. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows, below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they are widely recognized by traders, attracting more stop loss and pending orders, increasing the likelihood of price moving toward them to absorb liquidity. Now let's focus on practical liquidity patterns and scenarios that are more likely to drive price movements compared to other liquidity zones. Identifying these zones on our price chart enhances the reliability of our trading strategies, improving the probability of successful outcomes. The first practical liquidity pattern we should consistently seek in the market is characterized by equal lows and equal highs. As the term suggests, when the price establishes internal lows at the same level, we identify it as an equal low. Similarly, when the price forms internal highs at the same level, it's recognized as an equal high. Equal lows and equal highs fall into two distinct categories: double bottom or double top, and triple bottom or triple top patterns. Now let's delve into the specifics of each pattern and explore the psychology behind their formation within the market. Let's begin with the bullish equal lows double bottom patterns. Imagine a scenario where the price creates a bullish break of structure, pushes upward, and then retraces back down, failing to reach the demand zone generated by the bullish wave. Instead, the price forms an internal low. It attempts another push upward, but the bullish momentum is insufficient to break the recent major high. Subsequently, the price experiences another pullback and can't break the recent internal low, resulting in the formation of a double bottom. During this phase, many retail traders who base their trades on chart patterns enter long positions upon identifying the double bottom pattern. They place their stop loss orders just below the equal lows, creating a significant liquidity pool. Consequently, the price experiences an upward rally movement driven by the buying pressure from the retail traders who entered long positions. As you are likely aware, smart money often manipulates the market, crafting scenarios that mislead traders into thinking they have a clear understanding of price action, only to lead them into traps to trigger stop losses and generate additional momentum. To gain a better understanding of the market manipulation methods that frequently occur, let's draw a bullish trend line by connecting the recent lows in the market. Many retail traders who use trend lines for trading view this bearish pullback as a breakout from the bullish trend line. They eagerly wait for the price to pull back, providing them with a selling opportunity. They believe that the market's bullish momentum has ended and the bulls have lost control when the price breaks below the trend line. These traders enter the market by taking short positions. As the price retraces upward, they also set their stop loss orders just above this internal high. Notably, the price shows a brief reaction to the trend line and experiences a temporary bearish wave. This reaction induces more traders to enter the market by opening short positions and placing their stop-loss orders above the recent internal high. This creates a perfect buy-side liquidity pool waiting to be cleared by the market. Subsequently, we see the price push higher, clearing the buy-side liquidity that it accumulated above the internal high. Now we have a demand zone located at the extreme alongside a substantial liquidity pool generated by the stop losses of retail traders. In this scenario, there is a high probability that the price will retrace, clear the liquidity below the equal highs, then touch the demand zone before reversing and resuming its primary direction. Therefore, our current approach is to patiently wait for the price to clear the liquidity below the equal lows and touch the demand zone. This offers the confluence factor we seek before entering a position. Consequently, we can initiate a long position from this demand zone as the market has already collected the stop losses of retail traders, and there is no further need to collect more stop losses. As a result, after the liquidity sweep, we can confidently enter a trade. Now, let's look at an example. Here we have an uptrend where the price has formed bullish breaks of structure. Within this context, we can identify two potential demand areas where the price could potentially reverse and continue its bullish trend. However, the key question is, how can we determine which of these zones is safer to trade and more likely to be respected by price? As discussed earlier, we only consider a zone as valid for trading if a liquidity sweep pattern has occurred below or above it. In this case, I will not consider this decisional order block as my point of interest because the price did not sweep any liquidity before reaching it. Instead, I view it as an inducement area that provides a liquidity pool below it in the market. Furthermore, there is a substantial liquidity pool formed below the equal lows and the inducement demand zone, suggesting the presence of pending orders and stop losses waiting to be triggered and swept by the market. By focusing on zones with liquidity sweep patterns, we can increase the probability of trading setups that align with market dynamics and reduce the risk of falling into false signals or traps. The presence of the liquidity pool above our identified demand zone provides additional confirmation for a potential price reversal from our point of interest. Now that we have the desired confluence, our next step is to patiently wait for the price to sweep the liquidity below the equal lows and the inducement area. Once the price enters our extreme order block zone, we can consider entering a trade. Moving forward, let's discuss the triple bottom. The principles that apply to the double bottom pattern also hold for the triple bottom. The only difference is that in a triple bottom, the price forms 3 equal lows instead of just 2. When retail traders identify a triple bottom pattern, they enter the market by opening long positions. They also position their stop-loss orders just below the equal lows, creating a substantial liquidity pool ready to be cleared. As the market's dominant direction is bullish, it must trigger a significant number of stop losses in order to continue its upward movement. Hence, when the liquidity pool formed by the accumulation of numerous stop losses and pending orders is cleared by the price, it signals an opportunity to consider entering a long position from the demand zone located below the liquidity pool. This is because there are no more stop losses left to be taken. Now let's move on to equal highs. As previously discussed, equal highs fall into two categories: double tops and triple tops. If we look at this double top pattern on the left side, it's clear that the bears are in control. After breaking the recent structure to the downside, the price rallied back up and formed 2 equal highs near the unmitigated supply zone associated with the bearish wave. The existence of these equal highs created a substantial liquidity pool above them, consisting of the stop losses of retail traders who had entered the market by taking sharp positions after identifying the double top pattern. In this scenario, it's highly likely that the price will move back up, clear the accumulated liquidity above the double tops, trigger the sell stop losses, touch the supply zone, and then reverse to continue its bearish movement. The same concepts apply to the triple top pattern. Numerous stop losses and pending orders are situated above the triple tops, increasing the likelihood that the price will return to clear the accumulated liquidity above the equal highs. As a result, we can consider initiating a short position from the upper supply zone. Since the market has already absorbed the stop losses of retail traders, there is no longer a need to collect more stop losses. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. To increase the likelihood of a successful trade with a high chance of winning, it's essential to enter the market after stop losses have been cleared. It's important to note that if the price doesn't clear the liquidity before reaching a point of interest, there's a strong likelihood that the price will use that zone as a source of liquidity to drive its momentum. Next, we'll explore the second practical liquidity pattern that we should consistently look for in the market: trendline liquidity. Let's start with the bullish scenario. Consider a structure like the one illustrated on the left side. We can see that the price formed a bullish break of structure to the upside, leaving a great inefficiency behind. Following the creation of a new major high, it retraced downward and then began forming a series of small breaks of structure with extremely tiny and choppy movements to the upside, without any significant liquidity sweeps. The key factor here is the repetitive formation of these small breaks of structure. In this scenario, the price is slowly moving upward while forming new, higher highs and higher lows that are in close proximity to each other. As a result, a trend line is generated by these minor highs and lows. Retail traders who rely on trend lines and chart patterns enter the market every time the price touches the trend line, placing their stop losses just below it. This approach results in the formation of a substantial liquidity pool, positioned just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely that the price will push back down to clear the liquidity below the trend line, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind and then tap into the demand zone situated at the extreme. This presents an opportunity to consider entering a long position from the demand zone situated below the liquidity pool. Since the market has already activated the stop losses of retail traders, there's no longer a need to collect more stop losses. The main purpose of the smart money concept is to enter the market only after the retail side's liquidity has been cleared. Hence, we should enter a position only when we identify a liquidity sweep on the retail side. Now let's move on to the bearish trendline scenario. The same concept applies to the bearish trendline. In this scenario, you can see that the price has formed a bearish break of structure, and there is an unmitigated supply zone generated by the bearish wave. The price moved downward with inefficiency and then started to form small breaks of structure to the downside repeatedly. Additionally, the price created a trend line using these minor structures. This trend line induced many retail traders to enter the market by taking short positions and placing their stop losses above the trend line. Consequently, a significant liquidity pool is positioned below the upper supply zone. All we need to do is wait for the price to clear the liquidity located above the trend line, triggering the stop losses and then reaching the supply zone. This provides a strong confluence factor we look for before entering a position. Consequently, we can open a short position from this supply zone after the liquidity from retail traders has been cleared and the inefficiency has been filled. There is a higher likelihood that the price will reverse from the upper supply zone and continue in its dominant direction, in this case, the bearish direction. In conclusion, understanding liquidity is crucial for successful trading. Recognizing liquidity patterns such as equal lows and highs and the tactics used by large financial institutions helps traders avoid common traps and make profitable trades. Mastering these concepts allows traders to anticipate market movements and make more informed decisions. Incorporating these insights into your trading strategy can enhance your ability to navigate the market, minimize losses, and increase success rates. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Comlu Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.